But it's a good morning. It is a good morning. So let's see here. Hope I can hear myself. Yep, I hear the old man. Okay, welcome. So if you turn your attention to the chart on the left-hand side, that is the 5-minute chart. It's set to regular trading hours. So that way I can adjust where we get our first opening price. I'll just drag this up here down to it. And this is a 15-second chart. And this black line in here says the previous settlement price, or where we stopped trading yesterday, 4:15 p.m. And there we go. So here is our opening range gap high. You guys know the protocol. First 30 minutes, we're looking for half the gap to fill. And here it is essentially done so, and the gap is real close to being filled already. And it's also inside of the new day opening gap, so it's a little lackluster in terms of what you might expect for big volatility. So it's really next to little unchanged in my opinion. So remember I was teaching you about how big the opening range gap is and what information you get from that. There isn't a large opening range gap today. It was a premium gap, so now we're below it. So you want to turn your attention to, and you can notice the difference between where we opened down here on the regular trading hours. That was the point of showing that. Now we're below it, so you want to see, do we have any respect inside this area here? It's also the consequent encroachment of the new day opening gap for today, so September 12th, new day opening gap. Now there's a little bit of a buy side and balance sell side efficiency on the hourly chart. I'll take you over to that real quick. And pop it up here like this. See where we're at in here. So that is something that might be a catalyst for us to then try to seek more of a premium, or try to explore the upper end of that opening range gap. Excuse me. And we'll put our quadrants on that buy side and balance sell side efficiency. I like the fact that we opened and trade lower, because that's punishing those individuals that want to chase the rally that was yesterday. And that's like very classic market making. So you can see we did trade in the upper quadrant of that 5-minute chart over here. So now we have a minor buy side here at the end dog for today at the low, the previous settlement price here, and then we have the opening range gap itself here. So we want to see if we can dig up into that. We have minor buy side sitting right up here at these highs. Right here. Looks like they're about to take those individuals out. See how we worked from dropping lower into that 5-minute buy side and balance sell side efficiency, which upsets this liquidity right here. And I was talking about, I did it on Twitter. I was on there the last couple days, fanning the flames, hanging out with the boys. So there's that minor buy side swept there. So it's almost like we know what we're doing around here. the lower run into this buy side imbalance, sell side inefficiency. If it's bullish, remember what I've been teaching in the 2024 mentorship. When there's an inefficiency, we are not looking for a complete overlap of that single candlestick that makes the inefficiency. We want to see sensitivity in the upper half of it. You can see that actually happening here. And then digging up into open, trading down to the top of that opening range gap, the high of it, and then rallying. So now we're going to turn our attention to exploring a little bit higher up and take ourselves back down into a 5-minute here. 4, 3, 2. Okay. You see how we just dropped down into the high of that opening range gap again? There's a small inefficiency in there as well. So allow it to get into that and see what it wants to do with that information. So for a model, you can use the one that was outlined over here. Narrative I shared on this morning. I want to see it drop down. It dropped down into a discount array, which is this buy side imbalance, sell side inefficiency. You can frame it with this candle's low, this candle's high. Upper half of that is where the sensitivity is going to be. It means if it's going to be bullish, that's where you want to find the setup. Or it trades down into it here. Then aimed for the opening range gap high. That would be a very, very low hanging fruit objective if you were trying to use this as an area to go long for that. And then the minor buy side liquidity was the next one. So far we have dropped initially, right from the opening bell. Opening bell is 9:30. And again, this chart here, don't get confused. It's a 15-second chart on the right-hand side. And that 30-minute opening price is here. 9:30 rather. Just doing some work inside the opening range gap. I'm actually going to change this color. It's a little too much attention placed on it. I don't want you being affected from a sentiment perspective. All right, so we have a very, very large, smooth area that we watched a week ago, 19,695. And if you look at it on a 60-minute chart, and we take it into electronic trading hours, yeah. Look how pretty that chart is, ICT. Good grief, you really keep your charts clean. Yeah, that's what a professional does. So if we look at how all these highs over here, see how clean they are? I mentioned this on Twitter. I'd like to see it drop down and then start working towards that level. Does it need to go there entirely today? No, but I'd like to see it try to march towards that now, because it's done a tremendous job of destroying any short sellers yesterday by just going higher and higher and higher and pressing into that. So that's kind of like what we're looking at for the remainder of the year. I think we're going to have a very, very busy fall going into the end of the year. So volatility is going to be off the charts. Like, it's going to be very, very fun, but very, very dangerous. So don't think that every bet should be heavy. You should be more inclined to lower your leverage, but your trade frequency can, if you're going to be working these lower time frames, that can actually be elevated a little bit more, because you're going to have a whole lot more setups if you know what you're looking for. right, so that's the smooth area I like longer term. That's what we're looking for. I'm going to drop back into a 1 minute chart here. It's playing a little dirty this morning. Back and forth in there, tagging that new day opening gap and previous settlement price multiple times inside that area. And your 933, 930, 931, 32, 33 candlestick. The opening range essentially is that first presentation fair value gap as well. So it would look like this. So you don't have that frame, but that would be your first fair value gap between 9:30 and 10 o'clock. Give it a little bit of time. It's working around inside that daily range from the highs here down to that low. Back into opening range gap. Opening range is a time, again, between 9:30 and 10. Okay, so it's the first 30 minutes of trading. And what you're looking for is initial buy side and sell side to be established. You're also looking for any initial PD array. So any significant break or any significant imbalance, buy side imbalance, sell side inefficiency, sell side imbalance, buy side inefficiency, busy, sissy, either or. And that'll give you the context for perhaps a silver bullet trade in 10 o'clock. Now look at the 1 minute chart over here. It's a little gnarly, isn't it? Now contrast that with days where it just has a really nice gap. It has very obvious buy side and sell side that has a range away from where it opens up at 9:30, and those buy side or sell side liquidity pools. And there's a larger gap opening. You don't want to be having a whole lot of excitement around days that have a very small opening range gap like we have here. It's literally like 15 handles or so. So it's not even very much between the previous settlement price and the opening price, which is the higher price between yesterday's settlement price and today's open. So that's what makes it the opening range gap high. And by definition, that would be the opening range gap low. So one of the things that we watch pre-market that means anything before 9:30 opening bell, is we're looking for, is it maintaining its opening range gap? Or as we get closer to 9:30, is it reducing it in size? Because if it's reducing it in size, that means we're going to probably have a very muddy morning, or at least the first 30 minutes could become potentially a very muddy session. And so far we have all of this choppiness in here. And while I would prefer seeing it go higher, there isn't anything in here to operate on. So we have to wait and let the market do what it wants to do. Keeping in mind that everybody on the street has saw that move yesterday, and they want to do what? They want to be long. So that initial drop down may not be all there is for a Judas swing here. So this drop down here, they may want to go one more time deeper than that. And anyone that's already long, they could be displaced from having that position and no longer be in the market. So it takes a little bit of patience working with these types of environments. And no one really should be looking at this and thinking, wow, I gotta get in on this. You know, it's gotta be, there's nothing better than this right now. The market's not really poised yet to do it. So just give it its chance to move around and finalize all of its opening range. 15 minutes is not enough information for the daily range. So it's a 30-minute algorithmic period between 9:30 a.m. Eastern Standard Time to 10 a.m. Eastern Standard Time. That is the algorithm's opening range. It sets up initial buy side and sell side and then operates with that. You can also do standard deviations on this range. Hello, hint, hint, nudge, nudge. So it gives you all of these projections. Usually I tuck that stuff deep inside the lectures, but I figured I'd toss that out there because some of you were falling asleep watching these candlesticks paint sideways. Yes, Virginia, if you take the highest high and the lowest low in the first 30 minutes and project them up, you're going to get your intermediate term and long-term daily intra-session highs and lows. Don't take my word for it. You got to see it for yourself, and you'll see there is an algorithm. All right, so here we are back inside the opening range gap. Now I like the idea of what it's doing in here because it's like falling short of going any higher above that 290 level, and we're back inside the opening range gap. We have relative equal lows in here, and again, this is a 15-second chart, so there's liquidity resting below into that. And I like to see it one more time go below these lows over here on the 1-minute chart, because again, I was saying earlier that everybody on the street, that means people that just watch the news, they watch CNBC, they read newspapers or articles, or they watch other people do something, and then because they did something previous day that was bullish or bearish, and it was a big day, and there's a lot of excitement about yesterday, they'll want to go in, and their bias will be, well, I want to do what was happening yesterday, because large ranges, it brings in a lot of excitement. And you can see how by the individuals that maybe would look to go long, or maybe that are long, naturally their stop loss is going to be right here below these lows in here. It takes a little bit of time watching price and presenting these a little bit harder conditions, where if you're just really impulsive and you want to take some action getting in because you think it's going to keep going up for a longer term, the first 30 minutes of the next trading day, if you sit still and don't do anything during that period, I promise you there's lots of other opportunities. You don't have to trade the morning session either. Like, you can literally just trade what? The afternoon session. So my question to you is how many of you already remembered that you're not supposed to be doing anything in the morning session today? That's a large range candle yesterday, right? On your daily chart. So the protocol is what? You don't trade in the morning session. If you're brand new, you don't trade the morning session. Now, someone that has a little bit more experience, we just banged the lower end of that new day opening gap over here for September 12th. That's today's new day opening gap. So we hit that. I'd like to see if we had any interest to explore lower low, not for the sake of expanding lower, but just to go down into maybe consequent encouragement of that 1 hour buy side and balance sell side efficiency. And there we go. So anyone that's long, they just had their bread toasted. This is what I meant by keeping your fingers out of the mashed potatoes. Large range days, you got to be careful in the morning session. They're going to punish anyone that wants to be on that same side of whatever the previous day's range was. If it's large on your daily chart, when that occurs, next morning session, sit still. Write it down in your journal. You have permission to sit still. You have permission not to trade the morning session. Remind yourself that. I promise you, you will probably save yourself a whole lot more frustration and equity, and not probably blow your account or go on tilt, because you're forcing something in an environment that's already predisposed to try to hurt individuals, doing the very thing that yesterday's daily candlestick showed. In other words, extremely bullishness. Okay, well, they're going to lay down a landmine field in the morning session, because what that does, let's make the argument for the sake of, if it's going to go higher, and it can, I'd like to see it go up there and take out that 19,695 level. I would like to see that disrupted, but it doesn't have to do that. It could do that months from now. It could do it years from now. Okay, or never. Right? Those are always possible scenarios. But because yesterday we had such a huge, very, very energetic, entertaining candle on the daily chart that just kept going higher and higher, that excitement bleeds into the next trading day. And now everybody's out here that are novice traders, let's look at it that way. They're excited. They want to be long. So they're going to take buys on everything that they can hear someone talk about, follow signals. If someone says something on online chats that's bullish, and what they want to do with their trading, that's going to be the catalyst to say, yep, that's all I needed, that little bit of a bump, and now I'm going to take initiative and get in there and trade long. And in the first 30 minutes of the session, what generally happens is it allows these types of traders to come in, and it lays down a little bit of breadcrumbs, like, hey, look, we're going up. And all of these little bull flags in here on the 15-second chart. And I liked how, like I said, it was failing to get up there. It means it's likely to do what? Roll over and dig into that buy side imbalance on the LRA chart, which is the shaded area is blue, and then take out that initial low of the day where there's sell side. So why would that be advantageous for the algorithm to do that? Why would it be a good thing to see something like that unfold? Well, because you actually have early buyers coming in trying to do what they saw yesterday's winning crowd do, be profitable being long. So if they lay down this landmine field of, here's a low, start sending it higher, opportunities to go in here, supply and demand, guys, okay, they'll call this a demand zone. And they give it to them here and here, and then, no, we're not going to let you go higher. And even the supply and demand dudes are going to be doing what? They're going to place their stop loss below there. Fibonacci traders are going to be buying down in here on retracements and ratios. And harmonic pattern traders are going to get all this little bit of a movement lower here, and they're going to get excited by that. And they're going to buy it. Moving average crossovers. Okay, every possible indicator that is an overbought, oversold momentum indicator, they're all oversold here. That's what retail traders like myself, when I was 20 years old in 1992, that was the secret to the market, I believe then. And then what? Everybody initially that's long on a large range day that closed higher, in the first 30 minutes, that low is always going to be a suspect low. Whatever low they form, and they paint this little tiny short-term low, always expect that scenario that they're going to lay that down as a trap. So you can use it as a turtle soup. You can use it as a scalp to trade down into that. Over here. Working the upper end of that opening range gap in here. Breaks lower, trades inside of this inefficiency, and returns right back into the end of, and then trades lower. Listen to the recording back at that period of time It'll all be in the recording. And it sweeps the low over here where the sell side is. Okay. Now it's accumulating inside the end dog. And I like to see them run up in here and clear up some of this buy side. And how we trade there once we get there will be indicative of any continuation going further. But we're still inside that 30-minute time frame. So you have to be careful. You don't want to be trying to bet the farm yet. Meaning you're not trying to secure the low of the day or the high of the day. They can play real dirty in this first 30 minutes. So we're still inside that opening range gap. There. End dog low. So what you're learning, Caleb, is things to lean on for logic, comparing what the daily range was and how price traded the previous day, and or excuse me, and or the last session of the day, meaning the PM session and the last hour trading. Seasonal allergies. I mentioned it the other day. You're probably going to have that frustration that I get sometimes. I when I listen to a speaker or I listen to an audiobook and they do their speaking and they either have a head cold or they're very mucusy, it's hard for me to focus on what they're saying because I'm hearing all their spit, their saliva. It's disgusting, isn't it? But I just got to show you, I'm not AI. Hey, how about that? All right, so we are inside of over here. Watch this. This candlestick's wick, midpoint, consequent encroachment. We came down, hit that. So I'm watching this level here as I'm watching the 15-second. Okay, so now what I'm about to say, just know that this doesn't mean it's the secret sauce to it. Okay, but I get questioned all the time is, how am I looking at all those monitors? Because I have a whole array of 12 monitors that are on my desk, and then I have several monitors to the right, and then I have a tablet, and then I have the laptop here that if I'm live streaming, I'm not in my office right now. I'm just simply looking at it. I'm actually on my bed right now. But what I'm watching is I'll have different time frames. Like I'll have a daily chart, I'll have a 4-hour chart, 1-hour chart, 15-minute chart, 5-minute chart, and then I have a matrix chart where it's the 5, 4, 3, 2, 1, and then I do the same thing with a 45-second, 30-second, 15-second, and 5-second matrix chart where I'm constantly going through my eyesight. My eyes are going to each one of those time frames, cycling through constantly. When I'm watching price, I'm constantly going through looking for that, and I'm looking for how traders would see those time frames and implement either an interest in buying or selling it, or where their stop loss would be placed in respect to that specific time frame. Because not everybody trades on a 1-minute chart, not everybody trades on a 5-minute chart. So when the market affords a 1-hour setup or a 4-hour setup, I'm constantly bringing that information into my mind in terms of building a narrative. What should the participants fall on in terms of ruin? How can these traders that are less informed fail today? That's what I'm looking for. I'm looking for that opportunity to see where I can see something that is, in my mind, high probability it's going to go to a specific level, go higher or lower. And then if I have that same thing unfolding at a time when something retail, some kind of retail pattern, a double touch or a triple touch to some kind of supposed diagonal trend line, or something nonsensical, some kind of pennant pattern or shape, some kind of shape that they see. Okay, it's kind of like when you look up in the clouds and you think you see a face or you see something else. Because our minds are designed to look for that. We're actually seeking the face of God, whether you believe it or not. And that's why we have that phenomenon always occur. We're always seeing like faces in things. Oh, I saw the face of so-and-so in my grilled cheese sandwich. That's actually occurring in everybody. Not that we would all see the same face in a grilled cheese sandwich, mind you, but we have that phenomenon occur in our minds because we're wired that way. So if you go in and you start building a sensitivity and opening your reticular activating system to the possibility of the market respecting, geometric patterns, triangles and whatnot, rhomboids, that to me is a little myopic. So you have to strip it down to what makes the markets go up. Buyers seeking what? Higher prices, and that buyer has to buy at a discount price, and that's what the algorithm affords it. Okay, so we've completed our 10 a.m. opening range gap. Opening range, and now we're inside of the opening range gap at the low of it, touching the end dog low right there. So now look at that 1 minute chart on the left hand side. Nothing in here is terribly exciting, is it? We're basically unchanged from where we closed yesterday. So how's that exciting? It's not. And this is typical of what you see on a morning session after a large range day. If it's higher or lower, it doesn't matter. It's not because it went higher, it's acting this way. The same thing is going to happen on a large range day that's on a down close. We have minor buy side here. Like that. Right up here. Okay. So we had sell side below this low here taken. Look at the bodies down here. What were the bodies respecting? The lower quadrant of that 1 hour buy side imbalance, sell side inefficiency. That's what this blue shaded area is over here, in case you just started watching the stream. So I'm going to take the 10 o'clock vertical lines off because they're no longer necessary to communicate the method. So touch the end dog high again here, and consequent encroachment of the opening range gap. I want to see if it can mount a run into the liquidity resting above the 288.75 level. The better trading should be in the afternoon, starting 1:30 p.m. Eastern Standard Time, going into the last hour of trading. Why? Because we had a very anemic opening. It was really small in terms of opening range gap. It's after what? A large range up day. So you can afford to go fishing on the morning sessions after a large range day, and then come back, grab some lunch, maybe take a nap, and then at 1:30 sit at your desk and then trade the afternoon session, because you're going to get a whole lot more cleaner price runs. You won't get a lot of this fickle back and forth where it's just, I don't want to go anywhere, ICT. Just needs to stay here. I'm going to stay in bed. That's what the market's basically saying right now. It wants to stay in bed. It's lazy. All right, so I would want to see it run here to that 288.75 level. If it's bullish, it should run here. But keep in mind, Caleb, while you're watching this, you're in a session post large range. So what does that mean? Setups are more prone to fail. That's the reason why you should not be trying to go in here and press it hard on a morning session after a large range day. That is a climate and a characteristic about the daily range that you have to at least be aware of. I didn't discover that, overnight. It took lots and lots of blown accounts, drawdown, and frustration. And I found out that what I was trying to do was I was taking my katana that had a razor sharp edge, and I was rubbing it against a concrete block like a saw, dulling it. So I was using my katana on something that it's not designed to cut. So you have to sit still, wait for the opportunity with the characteristics of the daily range to be there. Okay. You want a candlestick range theory. This is one of them. Okay. But you ain't hearing it in those dollar mentorships. Okay. The wish version of smart money. I tell you what, I'm really having a lot of fun being on Twitter again. I'm only visiting for a short while, mind you, but man, alive, it's a cesspool over there. Everybody knows nothing. All right, so we're back down into the end dog. So now imagine for a moment, okay, say for instance, Caleb, that you were wanting to trade today, okay, and the very first fair value gap that forms on the 1 minute chart is you have it at the 933 candle. So trading down into that, we get a delivery above the short-term high here, yes, by going here. But what happened after that? Right back into the range, and then attacked what I was outlining, that they would use the initial low of the day to target anyone that wants to chase the price that was delivered to the market yesterday, which is a very large up close day on the daily chart. So the market came down, took those individuals out. The bodies over here respected the buy side and balance, sell side efficiency of the hourly chart. That's that blue shaded area here, okay? And then they ran just for short-term liquidity there. And this big balanced area here is offering initial high resistance. So you have to sit still and take in more information. You're not trying to press the button on these sessions. You're not trying to be smart. You're not trying to be right, okay? What you're doing is you're seeing how are they hurting traders that just can't sit still. How are they doing that? They keep coming back, offering deep little, well, I shouldn't say deep. They keep causing retracements to take out short-term lows. But they're not letting the market go higher. You see that? Watch. Look at the 15-second chart. See this swing low? Actually, let's start over here with the initial. We have this low here, which is the upper quadrant of this blue shaded area, which is a 1 hour buy side and balance, sell side efficiency. The market trades down below that and then trades higher. It creates a swing low right there. You see that? That swing low, not because it has a swing low that has a higher low to the left of it and a higher low to the right of it. That doesn't make that swing low interesting to me, just because it does that. What makes it interesting is that swing low is forming at the high of the buy side and balance, sell side efficiency. That blue shaded area here on your hourly chart. Again, let me show you over here. So now if I don't do this, the new people get confused. This candlestick's high, this candlestick's low. This one big candle passing through, the difference between this candle's high, that candle's low, that inefficiency. That's what I'm measuring. I have a fib from here to here. So that upper quadrant level is where this swing low is forming. So that's going to have liquidity below it that has an interest in my mind. I'm interested in seeing that. So when I'm watching price deliver, is it doing a run below that? It does. And then you have this swing high, which happens to be just at the top of the opening range gap. That's this gray shaded area. Okay. So there's what's above that. It's buy side. So the market does what? It sweeps the sell side here, attacks the buy side here, and then the relative equal highs, it's taken that. And then we have a swing high here at the high end of the opening range gap again, and there's sell side below here. So we're digging into that. Every single time it takes the sell side, it's not coming up deep enough to get into that 19,288.75 level. So to me, when I see this, let's say for instance that we stay in the range between the low of this buy side and balance, sell side efficiency on this hourly chart. Say we don't take that out, but we maintain the highest high that's formed today. And we maintain that range throughout all the morning session and going into the lunch hour. So if I turn my charts on at, say, for instance, 1 o'clock, 1:15, right before 1:30, and that range still is there, then I'd be more inclined to expect to see them to release it and start exploring higher prices. Right now, they're just chopping people up because they all want to be on board. They all want to be on board. And every time short-term lows are being taken out, what's below that? Sell side. So again, why would that be Why would that be gainful? What would be the advantages of seeing that unfold? Someone's accumulating that. Someone's accumulating those stops that are being taken out, and you're thinking, well, Michael, this is a 15-second chart. Who's got stops below that? Everybody that you'll never meet out there. There's always somebody buying and selling. I mean, just look at social media. They're telling you that they're buying stuff and selling stuff based on nonsense, the stars, horoscopes, whatever. There's always buying and selling. That's gonna be in the marketplace. But my interest is, where can that buying and selling be targeted? It's not buying and selling pressure. It's buying and selling liquidity. that's the real mojo. Okay, it's not the buying and selling pressure. It's where are those orders and where are they laid in a manner where the narrative can exploit that. So, for instance, let's paint the scenario for a moment. Let's say that you are bearish. Okay, so you're bearish and you're expecting the market to go lower. Your eyesight should be keened on every short-term swing high, every time frame, and you would be watching and monitoring how price is delivered once it trades above those short-term highs. And if you are on side and you have the right analysis that you think the market is going lower, the market should accumulate those short-term highs for the purpose of taking the buy stops out, and then your mind should think, okay, if that's occurring, that means smart money is probably in the move right now. And they're building their position every time these short-term highs are taken. They're establishing the other side of those buy stops, and they're leaving their orders in because they expect what? A longer term move lower. Okay. Well, here we're seeing the exact opposite. We're seeing all the short-term lows here being swept there. These here being swept there, and that one making sure that one's gone. The buy side that's resting here, and the high of the morning session over here, where these clean highs are, that's where the next buy side would be. So we would have to measure what the delivery of price is once it gets above these levels here, because it's already done enough, in my opinion, to accumulate enough of the sell stops to then now allow for that daily range to try to flirt with a little bit of a, think about it. If they want to send price higher, they have to do what? They have to enter before it goes up. So what's the easiest way to find sellers at a cheap price? Take out short-term lows. And those short-term lows being taken out, that means that their sell stops, the retail-minded traders, and there's the buy side hit there. The sell stops being taken out affords the smart money to accumulate them. And see, retail is going to buy and sell, and be impulsive about what they're doing. Where smart money sits still and they wait. Because everybody's coming out here to the same watering hole. The initial, 30 minutes or so of trading, there's this big rush to do something. They're all thirsty. And most predators, they go to the watering hole at night. Because their prey are usually sleeping. Predators come at night and they get their drink. So they're not going to the watering hole in the day to drink down there with the gazelles and the antelope and the water buffalo and whatever goes down there, whatever they eat basically. They're in the tall grass waiting for them to go down. And when they walk into their crosshairs, proverbially speaking, they pounce on them to eat them. And that's what smart money's doing. It's waiting for these opportunities for the market participants to say, okay, I want to be on board in the marketplace long because that's what it did yesterday. And darn it, I just want to be on the right side once in a while. And I think it's going to go higher. Okay, well, wonderful. But as soon as the bell rings, they're going to go in there and do what? Buy, 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 buy. Or they'll wait for some kind of a initial support level. And when they see this type of movement here and it starts to rally up, well, highs are being taken there. That's a breakout. They're seeing what pattern in here? Bull flags. Bull flags. Oh, there's some support in here. and then it rolls over and goes where I told you to aim for, which is this low. And it went down below it after hitting the end dog. Go back and listen to the recording. It's going to go down here, from here rather, take out that initial low of the day. Why does it want to do that? Because it's engineering sentiment for traders to be discouraged. Oh, it's going to go lower. Okay, I wanted to go in and go long, but now it's going to go lower. So now I have to go short. Well, that's the same thing as a sell stop being hit, because now that same seller in the marketplace, smart money will accumulate a long position against that liquidity as well. So don't think for a second that it just has to be below no low. If the market starts to show like this feint of a move, like it wants to go lower, I told you it was just going to go down and take out that sell stops on the initial low. And then it cleared the relative equal highs over here. And look where it's pressing in here. Just alone, based on everything I've said here, like that is light years ahead of Wyckoff and all kinds of other stuff out there that people falsely attribute to me as repackaging. You're not going to find these types of insights in any other book. You're not going to get it, okay? You're not going to get it. Larry Williams didn't teach this. Linda Rasch and Larry Connors in their book, Street Smarts, didn't teach that. And without me explaining, like imagine just what I've talked about so far in the last 15 minutes. It would take me so many charts of every tiny little incremental move here to try to illustrate what I just did live. I can't put that kind of stuff in a book. That it's not efficiently delivered and taught in a book. Like you have to watch it being done over a live chart. That's the benefit of being mentored by someone that knows what they're talking about. They can explain it live over real-time price action. With a 15-second chart, reading it off of a higher time frame hourly chart. On Twitter, I told you I want to see it drop initially. And then work towards what? The 19,695 level, okay? Is that price here? Absolutely not, okay? But is it moving in that direction? Yes. And that's all you're looking for as a short-term intraday trader. You're looking for something to provide a catalyst. Okay, if you're bullish, what gives you the framework to trust that the market itself should go higher? Don't tell me the patterns that you're looking for. That's the least important thing, because that's your entry. The entry is not important. Why should the market go when you think it's going to go up? That's the more important question. And if you go in right out of the gate at 9:30 in the morning after a large range day, you're going to be met with adversities. And you're probably going to get stopped out. Even if you're right on the direction of where the market's going to likely go, or the short term, the intermediate term, or the long term draw on liquidity. If you're bullish, that means like where you think it's going to go to as a target. You may have all that right. But if you don't expect adversity, range bound time distortion, that's what you're experiencing in the first 30 minutes after a large range day, whether it's a bullish day or a bearish day. When you see a large range day, the next morning session, expect that first 30 minutes to just mark time. Okay, they call it barcoding or painting, this back and forth, up and down, watching paint dry and grass grows. Basically, what it's like. Okay, to me, it looks like a picket fence. This goes sideways. And that's what you're seeing essentially in price action in that first few minutes of trading. It's just like, and then you wait for a minute to move. What would that be? Well, as I outlined on Twitter this morning, I put a poll up, and I haven't looked at the poll's results yet. Okay, I posted it, and then I went and had some light breakfast with my wife while we were getting ready to start this live stream. And before I left Twitter, I told everybody, I said, I would rather see the market drop initially and then move towards that 19,695 level, because it's really smooth relative equal highs up there. There's like 4 or 5 highs up there that just did not get through last week. And we were giving it a chance to reach for it, but it just said, no, I'm not interested yet. And they had a nice drop away from that. Big drop, actually. So everybody has forgot about that level. Nobody has any interest in that level. And when I asked everyone to mark their 60-minute and 15-minute buy side and sell side, they're looking at, you know, the ones that were formed 5 candles ago on a 1 minute chart. You have to zoom out. You have to zoom out and see, okay, where can this thing be reaching for? And some of you completely forgot about that level up there. And it's still in the cards. It's still potentially possible for that to be traded to this week. It could be traded there today if it really wants to get wild and crazy about it. But that is a logical level to draw to because it's so smooth. It's so perfectly designed where they all agree with maybe just slightly lower than that. But that 19,695 level it's ripe for the picking, basically. Now we have some range to get through to get to that level. And I'm not saying it's going to be a straight line to it. But in my mind, that's what I was thinking about in terms of the narrative today. And when I'm live streaming this and I'm talking to you, that's why I felt confident about talking about how, see, I like how it's been keeping the ability to not go above that 288.75 level. Rewind it, you'll hear me talk about it. And then I think it's going to roll over and you can take out that initial low of the day. At the bottom end of that new dog or end dog, new day opening gap, at the time, I said, we're hitting that. We're going to see if it wants to roll over and take out that initial low. It does so. Towards what level? It's the lower quadrant of that 1 hour buy side and balance sell side inefficiency. So if it's bullish, is it better for it to come all the way down and touch this candle's high like everybody thinks that's how inefficiencies are traded? Bro, inefficiencies have always been around, bro. You didn't invent an inefficiency. No, I didn't invent an inefficiency. I invented the proper logic to trade them. Okay. And what you want to see is you want to see them not completely fill. You don't want to see them fill. You've never heard Chris Laurie teach that in any of his teachings. I have every single one of his recordings before he changed his what do you call it, his program that he asked me. He gave me login information. I didn't pay for that. He gave me login information to look at it and critique what he was doing. It was never in any of his lectures. So I don't teach liquidity voids being filled in completely next to your trade. It can trade all the way down to that low, but that's not what I'm looking for. And that's what I'm teaching you to look for. The opening, staying some portion open, because what that means is everybody thinks that this level is where it should trade to. If they have any understanding about market inefficiencies, they think that this candlestick's high here. They think this is the bee's knees, baby. They want to get in there and try to get in as low as they possibly can to buy that. And I am telling you, you want to grade that inefficiency that's defined like this, okay? Between this candle's low and this candle's high. And if you drop your fib on that and you put it in 25%, 50%, and 75% of that range, you can see what the algorithm will do because it's doing this very thing here. The mechanism that it's calculating on is they're taking this high, this low, and they're getting this level, and this level. And it will not, if it wants to go higher, it will not go down here and touch this one. That's what smart money's looking for. It's looking for this lower quadrant or halfway point. Ideally, you want to see it in the upper half. But if it's going to go below it, then it becomes essential for it to be respecting the lower quadrant and still leave that lower boundary point intact, not trade to it. That's what they want to see. Okay? So contrast that with everything else out there, and it's completely standing on its own. And that's what my challenge has always been. You know, I don't mind criticism. I don't mind skepticism. In fact, I encourage it. Look at the antics I put on social media. I want you to think, man, this guy's such a clown. I'm going to go out and prove. And guess what? You end up proving that I'm right. And then you're a student. And that's how it works. That's the way the exchange is here. I'm a market maker. I set you up. I give you a Judas swing. I tell you to chase something for the purpose of you think you're going to expose me and try to make me look stupid. But you end up making me look every bit of intelligent I claim to be in the beginning. And it's fun. And you love it. So anyway, the liquidity here was taken. So this is your Judas swing. It's a deferred market delivery. Whereas initially you have this, it drops down and gives you a short-term low, and then it rallies and they take out a short-term swing high, because what will traders think that do happen to be on side with, maybe they're expecting the market to go higher the next day after a big large range up close day. Maybe they're right, okay? Because sometimes, I was right, for a few months, not knowing what I was doing back in the 90s. I thought it was skill, admittedly, but I was humbled. It probably doesn't sound like I was humbled the way I talk, on Twitter, but they'll see that as a breakout. Now, I was never really a breakout trader. It didn't make any sense to me, because to me, it just means your stop has to be farther away. But I get it. There's a school of thought out there, and people out there claim to be profitable, that's how they trade. They never use a stop loss, and it's gambling, in my opinion. But that is still a trading approach that is used in the marketplace. When they have that confirmation, that they think is confirmation that the market's bullish, anyone and everyone that may take longs in this market, they're going to start looking for where their stop loss would be. And their only logical place at this point here, when there's a breakout, is it's this low. Can they hide that from you? Am I hiding it from you? I'm still seeing people tell them in the comment section that I'm hiding something. I'm literally explaining it. I'm explaining it so my son can understand it. And it's happening. It's unfolding as we talk about it. It's not hindsight. That low is your initial low on a day that is predisposed to go higher. So they're going to give them a trap. They're going to do what? The predator goes down to the watering hole. That's that blue shaded area here. That's that buy side balance, sell side efficiency. The predator at nighttime gets its drink, okay, and then it leaves. Then it comes back after all the gazelles, the water buffalo, they all start coming right here, because they saw the predator leave. They saw its foot tracks, the scent. Okay, yeah, the lions and the things that could eat me, they are no longer at their watering hole. So they come and they go down there and they start drinking. And this is exactly where the predator stalks. They want to eat. They're eating right in that little area there. So when it gets below this low here, this is your hunting zone. You're in there trying to consume less informed traders. I do not care if they lost money on the other side of my trade. That's the whole reason why I'm in here. I want them to go down. One swallow. Goodbye. You're consumed. Devoured. I'm hunting you. I'm teaching you how to hunt. Does a lion look down on its prey before it kills it and eats it? Does it apologize? No. Look what it does. It's swift about it. It tucks its head under its neck, goes right for the jugular, and crushes its windpipe. But it also, when it messes with hyenas, it'll run them down and break their back just for the fun of it, because it wants all the other ones to see what that lion does to that one. What do you think that is a metaphor for? In trading. That's what people do when they know what they're talking about, and they go in front of laughing hyenas and they show them every single day, I can break your spine and render you useless and toy with you. I'll eventually consume you, but that's not what you're seeing here. This is engineering liquidity. When the market trades down in below this low, there has to be some level, because we're not trading zones, okay? We're not doing supply and demand zones. We're trading very specific price levels. So this is why this is not supply and demand. What levels would there be an interest in? Well, you have this low here. I know this is some good stuff, isn't it? Can't believe you're getting this for free. Thank my son for it. You're a jerk. You should have always been teaching this way. Okay. I said it already, so you don't have to leave a comment now. All right, so that's sell side there. That's retail. Smart money waits for the algorithm, because it's two different things there. The algorithm is the price engine that drops price down there. That lets smart money accumulate their long positions at a time and place. Now, what's the missing pieces? Price. What price? Well, you have this buy sign, balance, sell sign, and efficiency. We grade that. Lower quadrant, consequent encroachment, upper quadrant, and the high. Where does this low form? Just above consequent encroachment. So if you are a trader that wants to scale in, you can't do this in certain prop firms, so you'll have to wait for what I'll show you in a second. You want to see it trade down into consequent encroachment. You can scale in and do one contract there. And if it gets down to the lower quadrant, you want to do one contract there. And then your stop needs to be at least 2 to 3 ticks below the buy sign, balance, sell sign, and efficiency, because it can touch the low. We don't want to happen, but you have to afford yourself the potential seeing that deliver all the way down to that candlestick's high down here on the hourly chart. Okay, so the price levels you're looking for is the lower quadrant and consequent encroachment. And then any inefficiency between those two price points. Watch. PhD level. Oh my goodness, man, this is amazing. I know. I actually have old floor traders and I have quote unquote institutional guys in the comment section telling me this is mind blowing. Yes, of course it is. It's ICT talking about it. What are you talking about? Why are you surprised? So we have this price level here and this price level here. So when price trades into it there, that is a what? As a potential entry. Now, would it be wise for you, just because it trades down there on a down candle, would that be wise to trade that? No. Just simply because it's cheap and it's at the price level, is that a good time to be a buyer? No. Because we have to be a buyer after it shows us it's given enough information. We're not looking for confirmation per se. We're just looking for a little bit more, because this thing could still drop all the way down to the low of that buy sign, balance, sell sign, efficiency, which is on the hourly chart over here. Okay, so what we could look for is price trading down to consequent encroachment, and we know that it could potentially trade down to the lower quadrant too. So you could do one contract here just to make sure you got something on. Now, if you're in a certain particular prop firm, you won't be able to add the next position where I'm going to show you, because they're going to say that you're, I forgot what they call it. I saw other YouTubers talking about that you're averaging in and you're adding to a losing trade. So they don't apparently want you doing that, and I guess that's okay. But here's how you turn that upside down against that. Okay, you see this price, you wait for it to trade to it, and then watch how it behaves. It trades to it, returns back up into old low. This portion of this SIBI, which is this candlestick's low to this candlestick's high, the most sensitive price points are going to be in the lower half of it. That's this. Watch. These are all the things that you're supposed to be doing every night, Caleb, and all of you that are watching. You want to look at all these price fronts and see, this is a signature. Does it get up there to the midpoint? No. So what does that mean? It's weak. So it's going to go to the next level. What level? This level down here, the lower quadrant of the buy sign, balance, sell sign, efficiency. So when we're seeing that, we wait for it to drop down. Then this candle, we open up, trade right to this candlestick's low. What is that? That's an immediate rebalance. Every single one of you should be screenshot. I'll move out of the way. Screenshot this candlestick's high right here. I'll move my cursor out of the way in a second, but what you're going to do is you're going to load a line on here and draw that out in time, or you can draw it this way and annotate that as a immediate rebalance, and the market drops aggressively. Go ahead and take a shot of that right there. And then also this discount wick. Look what it's doing. It's always been in front of you, but you never noticed it. So you have immediate rebalance plus consequent encroachment. Oh my goodness. And it's also trading where? Near consequent encroachment of the buy sign, balance, sell sign, efficiency. So that's not one thing. That's not two things. That's three things. And the price goes down and hits the lower quadrant and trades just a little bit past it. Now here's where it gets fun. If we don't want to see that lower quadrant traded to, because in an ideal world, optimally, that's how it should be. If that's the case, I know you're watching this thinking, damn, this guy's good. Look at this. It's so amazing, right? I know it's freaking boring, but I love that you get excited about it. I get off on it. I love living vicarious through all of you experiencing it for the first time. So this candlestick right here hits the lower quadrant. Let it sweep this level, that lower quadrant of the buy side balance, sell side efficiency over here. It does that here. And then we see what the market trade higher. As soon as this candlestick right there, that opening price plus the volume imbalance that's there. See that? There's two PD arrays, two of them. After it's hit the lowest level that we want to see trade to, and it's already worked below it a little bit. Now we have the market trade higher right there. That makes that candlestick right there and these series of candlesticks. Here's some order block theory, okay? Here's a chapter coming out. Ready? You ready for it? This opening price. Oh, this is the good stuff. I am going to start writing this stuff down. I wasn't interested until you started talking about this ICT. Now I'm going to write this stuff down. And then you have this one. There. This is the change in the state of delivery right there. Now why? What's the point of that? Because we've already hit the lowest level that we want to see traded to in that buy side balance, sell side efficiency. See that? It went below it, traded higher, and then what happens the very next candle? We open up here. So there's a separation between this candlestick's close and this candlestick's open. See that? So this makes this what? At the time of this opening, that makes this a vacuum block where there's no price at all between these two candlesticks touching except for this wick. It trades down to this candlestick's close. That is an immediate rebalance because the wick is a gap. So we trade down immediately there, and then price starts to deliver all the way up to the first of all these down close candles. This is the high of your entire order block. Market opens up here, trades down into the order block here, and then starts sending price higher. Reaching up, creates a swing high towards the high end of that opening range gap. Sell side taken off that low. Low takes out that low. They are accumulating what? Sell side. To send it where? Higher. Boom. Now, if you're looking on a day there wasn't a very large range day, like say for instance yesterday, we didn't have this monster of a daily candlestick. Say it was just within the realm of an average daily range, maybe just a little bit above it. You could be trading the morning session and you would not have to incur all of the hardships that the initial 30 minutes of trading can afford you like it did today. And also, you're more inclined to see a more protracted run in price. That means where we took out the short-term high here. There. This high on the 1 minute chart is this line here on the 15-second chart. So we had high, slightly lower high, so relatively equal highs. They rallied it and then sank it. All of this type of price action, they're all characteristic of a trading session in the morning after a large range day. So my question to you is this. Do you want to trade when the market has these things that you have to worry about when your experience level's a lot lower because you're just now starting to learn about it? Or do you see the advantages of seeing these characteristics, okay? And this is what I should have done in the beginning when I was doing paid mentorship in 2016. I expected the people, because they paid, that they would just simply look at the logic, look at what I'm showing them in real-time price action, and teaching them that it was a graduated understanding. They can't learn it all in one time. There's no way I could teach everything in one session. There's so many things. I mean, you want the highest understanding of what price is likely to do and why it should algorithmically deliver. That can't be delivered in these little short videos that you're asking for. You have to treat it like college. This is the college degree that you really need. It's not the stuff they sell you in those indoctrination centers. So is it beneficial? This was the question I should have led into with my first teaching and should have repeated every single day for the first 3 months back in 2016 through paid mentorship. I'm going to show you conditions in a good low resistance market condition, and I'm going to show you characteristics and price delivery in high resistance conditions. So that means you're going to see what it looks like on both sides of the spectrum. Now, the advantages are, and this is what you don't realize when you start studying with me, is when price is in a condition or characteristic that's defined by in the morning session after a large range day. I've taught this. I've never deviated from this, and this was something I picked up in 1995. I do not deviate from this. Every single time after there's a large range day, I always remind my students of this. The morning session after, you have to be extremely careful not to get all caught up and think that you have, everything figured out. Not in the beginning. Again, the beginning, you're not gonna know what you think you should know, and you're gonna discover that you don't know what you should have known because your experience level is just not there yet, and that's a normal thing. But do you agree? Do you agree that it is advantageous? That means it's helpful to you. It's helpful for you to recognize that this watering hole has a whole lot more predators around it than another time when there is less foot traffic on the ground in the sand. You can see that there hasn't been a whole lot of activity around the water hole. So you're probably going to be able to make it out of the scene after you get your drink. In plain terms, it's this. Do you think it's helpful to you to know when you're probably going to lose money easily? What's going to make your trade harder to pan out? So you want to know what it looks like to trade in low resistance liquidity runs. Okay, yeah, I want to teach it to you, and I have been. But the easiest way to determine what that is by showing you what it looks like when it's harder. But you want to avoid those things. They'll only talk to me when it's going to be easy, ICT. Just tell me you know what the market's going to do, so just tell us what the market's going to do. I am. But you're not liking the way that medicine tastes. And instead of swallowing, you're spitting it out. And that's going to be used in sound clips. And it wasn't intended for that purpose, but you get what I'm saying. So the point is this. By learning the difficult pathways to where you're trying to get, you'll also know that there are certain pathways that are actually a lot more smoother. There's no rocks in it. It's soft soil. There's no thorn bushes. It's a little bit wider. You can see down the pathway a little bit further. But the only way you can appreciate that way of doing it is by walking through the bramble bush, walking through the stony pathways that have lots of things that's going to scratch you all up. It's going to feel like, I don't want to do this. That's exactly how you should study. Because trading is going to present those characteristics to you. If you stay in this industry long enough, you're going to see that happen. There's going to be periods where your trading is going to be like that. But there are specific and generic trading times where the market will present these unfortunate characteristics where you just can't go in one entry and keep pyramiding and it's never going to retrace on you and just keeps running in your favor. You're going to be in like quicksand initially, where it's like it's hard to feel what it's doing. And if you watch live streamers, I mean, maybe they'll do it less now because I taught today, but because they live stream, they feel obligated to perform for you. And to me, that's one of the weaknesses of live streaming, because if you're trying to constantly promote something or prove that you can do something, you're not making it about sound, low risk, high probability trading, you're in the business of entertaining. I'm not here to entertain you. I'm not here for that. I'm here to teach my son how to navigate this stuff. And there's going to be times, even though he's my son, even though he has the access to Enigma, which is me, I'm Enigma. There is no higher order of being able to read price. This son of mine has all those advantages, but he still has the likelihood of falling victim to the conditions of the marketplace that he might think he sees something in it. Because his myopic experience, it's very limited in the beginning. And males tend to think that they can run faster before they learn how to crawl. While I don't believe that that's the case for my son, I'm removing any of that enticement by reminding him and teaching him that after large range days on a daily chart, the next morning session, that means all the way through lunch. Now think about it. How do you fight FOMO? How do you fight the fear of missing out, Michael? How do you teach your students to wrestle with all this, because you have all these things and people can teach, your stuff because they can use hindsight moves and entices people to take new trades. And I feel like I'm missing out when I see your trade executions. You're all worrying about the wrong things. Instead of saying, how can I know that I'm doing the right thing by sitting on my hands? The richest traders in the world are the ones that have well-written plans of inactivity. I'm going to say that in another way. The richest traders are the ones that have planned stillness. That means they're not trying to trade. Sure, these markets are moving around. They absolutely are moving around. But they're not in here to prove that they can navigate every fluctuation. They want to be in the markets when its highest degree of probability is in their favor, not in the market's favor. Do you want to go in a condition where you have the highest probability of having your ass torn off, or that you have done your due diligence and you have waited to a proper time when there is no large range day the previous day that would negate you trading in the morning session because your experience level is not there? I'm not saying that my advanced students have been around and have matured after being with me for a while and they know their model. There are trades that you can take. I'm not saying that you should not all trade at any given time, ever trading on a morning session after a large trading day. I'm not saying that. What I'm saying is as a student, and I'm talking to my son, he can't do this yet. So if you're like him and you just can't walk out there and take down a pound of flesh in trading every single day and know what you're trading for, if you can't do that, then you should not be engaging in the morning session after a large range day. How hard is that? It's a very simple thing, but it's hard to communicate because people, I have lots of students that just simply will not listen to that. And they complain, I can't make any money. I can't do this. I can't do that. This stuff is so hard. What are you doing? Well, I took this trade here. What day is today? It's the day after yesterday. It's a large range day. And I'm trying to trade in the session here. And I'm going against what would normally be expected as a bias. And everything's wrong. So that tells me they didn't do anything right in terms of studying. They didn't journal. They didn't talk about in their own annotations what they struggle with. So that way they can identify what they are. They're walking around with blinders on. And they just want things to work perfectly for them. And it doesn't work that way. I wasted years doing that stuff. Expecting something, just to click. And it didn't click. it didn't click. I had to have an intervention, they'll call it that way. And then things started being visible to me. But you have to appreciate when the markets are a little bit harder, when they're being held at bay, where they are not allowed to just run around and do whatever they want to do. As soon as you can recognize that condition in the marketplace, the better. And as soon as you recognize it, turn your charts off and walk away and come back the next session. And since it's the morning session here today, the easiest thing would be to turn off your charts, let it do whatever it wants to do all through until 1:30 in the afternoon later today. And then sit down, determine where the highest high and the lowest low of the day is. Look at the morning session high, the low of the day in the morning session. And then what was the highs that was formed in between those two reference points. The next highest, or the next lower highest, and the next higher low inside that range that defines the highest high and the lowest low at 130. There's two buy sides that you'll have, and there's two sell sides that you'll have. Chances are it's not going to take out both of the highest high and the lowest low again going into the PM session, but it will gravitate to one of them. And the question is which one do you think, without even being at 130 yet, which one is it most likely going to do? I want you to write that down in your journal and put the time that you wrote down. And then at 1:30, watch and see what price does. Discover where the two buy-side liquidities are and the two sell-side liquidities are. You have your lunch high, your lunch low, and you have the high of the day and the low of the day. That's what you walk into the afternoon session doing. It's the same thing that you would do in the London session. You're just going to use the previous trading session the same way. I don't need to be up at London to do it. I just told you how to do it right there. The previous day's high and low, and then the high and the low that's inside that previous day's range that's formed up to 2 o'clock in the morning Eastern time. That's what you're looking for. And then tomorrow, if we don't have a large range day tomorrow, if we don't have a large range day today, tomorrow's morning session will be easy. So you can see how all these things, because you have protocols, you're learning my protocols, and the things and processes that determine when I should do something and when I shouldn't do something. When do I push the pedal to the floor and just go all out? When should I just pump the brakes and slow down? And when should I just turn the ignition off, park it, and go do something else? How often have you thought about that for your trading instead of just go, go, go? Let's go. Let's effing go. Let's effing go. That's everybody wants to do that. And you have to learn to acknowledge when the market's saying it's amateur hour right now. So anybody that comes in here is getting slaughtered. Do you want to go to a rave where everybody's most likely getting murdered? You want to go there? I want to go to the one that has that experience, okay? Versus one that's just got great music. It's a really good, healthy environment. There's no drugs. There's no solicitation for any kind of thing that they're illegal. And you're just having a really good time with friends and listening to good music. Obviously, you'd want to go to the second one, right? So treat the market like a slaughterhouse. You don't want to be in here as a sheep because you're going to get slaughtered. You're not going to come out with all of your appendages intact. You're going to lose something. You're going to leave something in here if you try to trade on these days with no understanding and you disregard what I'm teaching. The morning session after a large range day, you have to be either dialed in and know exactly what you're looking for, and you're none of you are there yet. None of you are there yet. Okay, I promise you're not there. So it's good medicine, and it's responsible of me as an educator to tell you to simply sit still and don't do anything. Tape read it. That means you're not even demo trading it. I don't know. Maybe you've probably done some demo trading this morning. Maybe you did something right. Maybe you did something wrong. Chalk it up as bullshit. And I mean that because you probably don't know what you did and why you did it. And you're going to think that it means that you're better than you really are. And you're going to have that inflated state of mind about yourself. And you're going to go and repeat the same mistake next time you have a very large range day. You're going to go in there and try to trade again, but you might do it with a funded account. You might do it with real money. And then now the outcome is unfavorable and you're going to be upset. And you can avoid all that. You can avoid saying, I'm going to never do that again by simply never doing it the first time. So let's take a look at what we have here. And I'm going to close it up because I went a little bit past. I really did want to go and close it at 11:30, but there's a lot of points that I want to make sure Caleb understood here. Alrighty, so we have, let's work on this chart over here. Let's go to a 15-minute time frame. Take this off. I do like the fact that we started the day off going deeper, lower. We took out the minor buy side. We only had a shallow retracement. We didn't come down and take out the low of the day, which is all positive for the afternoon session. So as long as we start working towards any consolidation but not taking out that low, my expectation would be enjoy lunch, just relax, come back to your charts around 1:15, 1:30 p.m. Eastern Standard Time, okay? And then observe where the highest high and the lowest low of the day is on a 15-minute time frame. Then drop down to a 5-minute chart, and then you'll see lower, smaller short-term highs and lows that are inside the high and the low of the day, or respectively high and low of the day. And it may be a slightly higher high, but whatever that high is at 1:30, you note that, and then you note the low, and then you use either the lower high that you can see maybe on a 15-minute chart, or the 5-minute chart. If you can't see it obviously on a 5-minute chart, you drop down to a 1-minute chart, you'll see the lower high that's less than the highest high of the day or the lowest of the low. So you're going to have 2 layers of buy side and sell side, or you'll watch that form as 1:30's trading unfolds going into 2 o'clock. And then at 2 o'clock, what you'll see is the PM session unfold, and it'll start to traverse to either the buy side or the sell side. And I'm inclined to think that they're going to reach for that 19,695 level eventually. Does it need to trade there today? No. So in my mind, I want to see them give me a market structure and opportunities for the market to build that narrative in price. And at 1:30, I'll be looking for that. And if I have something that I like, I will engage it. I will trade it. I will annotate it. I will go through all the motions of doing that. And then you'll see another example. Okay, so I'm literally tipping my hand to you, telling you how to navigate it on problematic sessions, which is after very large range days in the morning session. And then what I use as a protocol. It's going to be the same stuff in the book, folks. So I'm telling you, you do not need to buy my books. Don't wait for a book and then miss all this opportunity to learn, because I'm doing it dynamically over the charts, live. Like before it happens, I'm telling you on all these little time frames how it should be behaving. What's it doing it for? Why is it going here? Why should it behave that way? And then I'm telling you what I'm going to do in the afternoon. Every single time I trade in the afternoon session, it's what I just explained to you. That never changes. It never, ever changes. All I want to see is where the liquidity is for the highest high and the lowest low of the day. And then I want to wait and see, does it make a shorter high or a higher low, basically, than the low of the day. And it will go to one of them. And price isn't going to hide where it wants to go. It's going to be obvious what it's going to aim for. And that sets up the framework for the afternoon session. Now, what makes it exciting is in the last hour or so, the opportunity for the market to expand. Okay, I saw somebody say the other day, generally, the last hour of the day, you don't see the market trade and make a new high of the day or low of the day. That's bullshit. That is absolute bullshit, because that's where it's creating the high and low of the day. And then towards the last 45 minutes, that's when it usually comes off of whatever high or low of the day, and then it goes into settlement. There's 4 macros in that last hour. Okay, so technically 5 if you really want to be dogmatic about it, at the 2 o'clock bleed over into 3 o'clock, but that's another discussion. But the last hour of the day is them actually pricing in the extreme high or low of the day on big expansion candles, like a day where we open near the low and close at the high. That last hour of trading, that's what's giving you that setup. It's going to reach and make a higher high when it's bullish, or it's going to reach and make a lower low when it's bearish. And in that last 45 minutes, you're basically trying to get a read for how they're going to settle in. Are they going to settle at the high, or are they going to come off that high and come back down into the range? And that's what my focus is. That's what I'm trying to trade with. You don't ever need to trade the morning session, ever. The easier trades always are going to be in the afternoon. The PM trading session is the easiest trading session for index futures. Always, always, always. It's the easiest, absolute easiest, because you have all the daily range already in there. Now, are you going to get the lines portion of the moves? Absolutely not. But that's what everybody wants in the beginning. They want the lines portion when you're not going to get the lines portion. But to get in there and get consistent setups that are going to yield to you, that PM session is always ripe for the picking. So that's going to be it for today. I covered a lot of stuff. I went through things that are going to help you avoid drawdown, losing, frustration, getting stopped out or chopped up, as they call it. The chop is real, right, Patrick? The benefits of knowing this information, you can't appreciate that yet until you start working with every single day, whether you're trading with a funded account challenge, or live or demo. You're going to see the problems of working with the morning session after a large range day. And if you don't log these events and characteristics in your journal, you won't retain them. You'll get caught up in the FOMO. You'll be watching something on social media. Maybe I might inspire you because I did a trade and I recorded it, or I said something in a live stream. You're like, oh, I'm going to do something. You know, that's the worst thing to do because you didn't plan that trade. You're impulsively reacting to some kind of stimuli, and never take any trades when it's like that. Okay. So that's going to be it for today. Until I talk to you tomorrow, Lord willing, be safe.